Okay, well, welcome everybody to this evening's seminar under the Political Economy and Financial Markets programme. We have today Piroska Nagy from the EBRD, and she's going to tell us about the challenges of spillovers from the EU banking union for emerging market economies in Eastern Europe. And Piroska is Director for Country Strategy and Policy at the Office of the Chief Economist at the EBRD. And her responsibilities include the strategic direction for the EBRD in countries in emerging Europe and Central Asia. There are 36 countries in all the client countries of the EBRD. And she also oversees the EBRD's quarterly economic forecast exercise, amongst others.
Yes.
Yep. Prior to the EBRD, she worked for many years at the IMF, which is how I knew her. First in the European Department, then in what was known as European II, when the European Department was split to accommodate the former Soviet Union. And then you were also in Jerusalem for a while, the Hebrew University, on sabbatical. And you worked, when you came back, in the African department of the IMF, and then after that you worked for Fitch here in London, and then ended up at the EBRD. She's published on a wide range of issues, and is author of the book called The Meltdown of the Russian State, which seems to me to be quite an interesting title in view of what's going on right now. You have a degree from Budapest, and also you did postgraduate work at the George Washington University in Washington, D.C. So I'll now hand over to you.
Okay. Thank you very much, Adam. Thank you all very much for coming here at this late hour. I hope to make it worthwhile for you. Before starting my little presentation, I would like to thank the PEFM time series, particularly Max, who cannot be with us, but who actually encouraged me to make this presentation and invited me. I hope that he is getting well very soon, and if need be, I'm very happy to give him a personal presentation. You can be the judge whether this is worthwhile at the end of my little talk. Thank you also, Adam, for accepting to chair this session.
Before we start, let me say that this is going to be podcast. Okay. So it's in the public domain, but then afterwards we'll have Q&A, which will be on Chatham House rules.
Okay. Thank you very much. So I have restructured a little bit the title of the presentation. Instead of spillovers, on second thought, I saw that I would turn it around and look at the banking union from the emerging European perspective. So what I'm not going to talk about actually is what the banking union is about. I'm sure all of you know that back in mid-2012, in one of the big crisis moments of the Eurozone, there was a realization that actually a banking union type of project would be very useful to address some of the major problems, linkages between the sovereign and the banking system, the fragmentation of the Eurozone markets that had taken place by that time. And very courageously, the European leaders endorsed in, I believe, end of June 2012, this whole banking union project. And I'm not going to tell you that it has three pillars, because is the single supervisory mechanism, which has just been launched, ECB at the helm on November 4th. It also has two other major pillars. One is the single resolution mechanism, which looks at the backdoor fiscal backstop, how to address the problem of resolving and restructuring a cross-border bank in a crisis situation. So that's the second pillar that will be started in 2016. And the third pillar, which is down the road, I think is 2025, which is supposedly will be fully adopted, which is a common deposit insurance scheme for the whole banking union. So that's the big project. The first part, the single supervisory mechanism, is already alive for 2 or 3 weeks. But this is just the background for us today. Today I'm going to tell you where emerging Europe is coming into this whole project. So that's the focus. So let's get started. So indeed the outline is under 4 major headings is the history of emerging Europe and financial sector integration. And what I'm going to show you is that emerging Europe actually had been much more integrated with advanced Europe than advanced Europe within itself, than the Eurozone within itself, both in terms of debt flows and in terms of equity, cross-border equity, which is very minimal, very low in the Eurozone context. And I will show you that actually this integration was very much missing something that is matched. The financial market integration was missing a matching regulatory integration at the cross-border. And it became a huge problem when the global financial crisis hit. And jointly with IFIs and the Commission, we really had to find some stopgap measure to make up for this regulatory gap. So in some sense, and that will be my third point, the banking union is offering potentially a solution for this huge regulatory gap that exists for emerging Europe, given that its financial sector is so much integrated with advanced Europe, Eurozone-based parent banking. And then a few words about what is the latest vogue with the new commission coming in. What is on the agenda is the capital markets union. So going beyond the banking union, of course inclusive, but looking beyond that and looking at cross-border equity relationship. That's the new thing, the capital markets union, and what it really is heading and what it might mean for emerging Europe. So let's see a little bit the history and the economic model of Central Eastern Europe. On this chart, on the vertical axis, you see savings and investment in red lines, savings in blue lines, expressed as a share of GDP from 2000 until 2012, but we can, of course, update it. The story is really the same in the next year, for which we would have the data 2013. What it tells you is the following, that as emerging Europe's market transition followed the Berlin Wall 1989 and the first decade of a lot of turbulence, but with a positive outcome, as transition really started to rebound, investment went up a lot. You see from below 25 to like 30 to 33%. While at the same time, domestic savings, the blue line, did not really follow through, so that stayed pretty constant. The difference in macro terms between domestic savings and investment is the current account imbalance, the use of foreign savings. So what you see that it's already at the beginning of 2000, there was a significant deficit, current account, external account deficit difference between investment and savings, and then that grew in the run-up of the financial crisis, 2007, 2008. You see, the gap widened. And in some countries, the current account deficit was running actually above 20% of GDP, Bulgaria and the Baltic countries. Way above what normally economists would think as something sustainable. Now, how was this financed? And that's the interesting story in emerging Europe. It's been financed by private capital inflows, and that is what the bars below indicate. The green is FDI, very significant FDI inflows, or equity coming to the region, and other capital flows, primarily of course portfolio flows, also being significant. And note that significance of more volatile portfolio inflows increased just in the run-up of the crisis up to 2007. And then came the crisis. And what happened is, well, usually crisis investment collapsed. So there is a big decline in the red line. And there has been some adjustment also, increase in domestic savings, not very significant, a couple of percentage points of GDP, which then together closed the external, at the regional level, the external current account deficit. So more or less, the region balanced, but not in a very positive way, of course, because investment collapsed, balanced its external account. And indeed, in terms of financing, FDI, the green little line, which is supposed to be, and it has been indeed relatively stable, declined, but less than before, but still positive in net terms for the region, it remained, but portfolio inflows turned negative. So that's pretty much the model. So there was a huge private capital inflow financed, very little official inflows actually. Almost in the as a result of the crisis, there would have been. It has been private capital inflows financed a growth model and convergence. Now, a lot of it has been all the capital inflows. A lot of it has been actually transmitted via cross-border banking. I take a step back. Follow the Berlin Wall. Of course, there were no banking system to speak of. There was big homogeneous central banking, commercial banking together, and countries had to privatize. And primarily, I have to say, all the countries primarily they wanted to try to privatize their banks to local investors, of which there were only a few very dodgy ones. So what we've seen, a lot of financial crisis in my own country, Hungary, there has been 3 rounds of financial crisis costing the taxpayer 15 percentage point of GDP altogether. And that was the same story in the Czech Republic. You might remember in the 1990s there was a big banking crisis in Bulgaria, Romania, wherever you lived, even in Poland. There were significant banking sector stresses. So finally, running out of all the bad options, policymakers did what they really had to do, and it also has been supported by top-down EU conversion. They privatized to foreigners, primarily to banks based in the Eurozone. Austrian banks, and this is what this chart is going to show you, Austrian banks increased their exposure in equity, not only that, to many countries. Italy, the second biggest investor in banking sectors, going as far as Kazakhstan, got burned, of course. They had to sell in the end, following the global financial crisis. Sweden, the primary target has been, of course, the Baltics, but they ventured down to Ukraine and Russia as well. Denmark, Greece. As the southern Eastern European region stabilized, Greece banks acquired major banks in Romania, Bulgaria, and many other countries. Germany, the Netherlands, major acquisitions in a number of countries. Belgium, KBC as a leader. France, major investments everywhere, even the UK, even Ireland. We don't even show here that Ireland was equity stakeholder in a Georgian bank. Imagine. Portugal. Then, in the end, Hungary, OTP, the semi-domestically owned bank, started also to make acquisitions in a number of countries. So it's become really a very, very deeply integrated markets where foreign ownership by Eurozone-based banks went up to as high as 100%, say Estonia or Croatia, many of the southern, the Serbia, very few domestic banks. Hungary as an exception, OTP, 1/3 perhaps of the banking sector remained in local hands, but a lot of the shares are on the stock exchange. And then Poland also had a certain domestic share, but dominantly foreign owned. Both equity, cross-border equity, and debt finance. So that's the story. But there has been no corresponding regulatory integration. So these big banks who brought foreign capital and brought know-how remained very much regulated by their home country authorities. So by the Austrians, by the Italians, by the Greek, by the Belgians, the French. So pretty much they were running the show. And it was, of course, partly because the local regulators, the so-called host regulators, that framework, that was pretty underdeveloped. Post-Berlin War, there were very little supervisory system, so that had to be built up. But it's partly because the home countries were calling the shots. They were better, more knowledgeable, and basically there was very little collaboration. Formally, of course, MOUs, etc. De facto, very little coordination between the home countries, the Austrians, Italians, and the host countries, the Polish, the Hungarians, Romanians, etc. authorities. But the model, and I wanted to stress because this is quite important, I think, the model, this very close integration and foreign capital financed convergence, did work for this region. Here I'm showing you two samples. One is the non-transition emerging market sample. This is on the left-hand side. Another is the transition post-communist countries region. Showing the relationship between growth per capita on the horizontal and the external current account on the vertical axis for both. As we know, usually there is no strong relationship. It's one of the oddities of development finance. There is no strong relationship between foreign capital and growth. Here, on the left-hand side, in emerging markets, you can see that growth is really not associated with a higher external capital current account deficit. So, say -20, actually growth is lower, and a higher capital account, less foreign savings use, is associated with higher growth. The opposite is the case in the transition region, the post-communist countries, where actually the higher external account deficit, high use of foreign savings, difference between savings and investment is associated with growth. And we rerun this post-2008 with numbers on 2011, and the relationship stayed the same. So what it means that really for emerging Europe, this close convergence, despite the regulatory oddities and a lack of regulatory coordination, actually for growth has worked. And indeed, just another slide to show this, that if we look at growth and look at the various factors of production, the strongest contribution in our region came from productivity growth in this period. So growth really has worked. This is just to show you. We show between 1993 2010 growth, cumulative growth in Latin America, emerging Asia. Obviously, they includes China, so they grew the most. SAMET is our new region, the North Africa region, not very important for today's discussion, and overall transition countries, all the post-communist countries on the right-hand side. The blue shows the productivity growth. So most of the growth on the back of course, capital infusion, but most of the growth really came from productivity growth, which was fueled by know-how and knowledge that foreign capital has brought into this region. So it has worked, this whole very strong integration, but with certain vulnerabilities. And indeed the crisis has exposed these vulnerabilities. What have been these? Number one, why it has been really a huge negative plus to have foreign ownership, cross-border ownership. In emerging Europe, very clear for growth. But political economy wise, it has shown certain problems. If there is no real local skin in the game for the regulators, it is quite easy to go after foreign owners at the time of stress. And unfortunately, we have seen this in Hungary, but also now in Poland, Romania, Bulgaria, that there is and in some quarters, to put it a little bit cautiously, there is a feeling that this foreign ownership is excessive, that there should be some targets for national ownership to balance foreign interest. So there is quite an important political economy problem coming from this. In economic terms, there have been a very heavy reliance on parent funding, as I showed, the difference between the savings investment that was foreign finance, and not on local deposits, and that brought about related very widespread foreign exchange lending. Because what parent banks and then domestic counterparts, OTP, copied the same model, did was to just provide funding or wholesale funding or directly from the parent bank for the subsidiaries in foreign exchange, offloading basically FX risk to borrowers whose income actually was in local currency. So we've seen a major mismatch, not on the bank's balance sheets. Subsidiaries borrowed in foreign exchange and lent in foreign exchange, but a major mismatch on companies and on households' balance sheets, because they borrowed in foreign exchange whereas their income was in local currency. And the last one is what I already highlighted and what is directly relevant for today's topic, that there was no real matching between at the regulatory level of the very tight relationship at the financial market level. And indeed, the crisis did test this very close integration. In this chart, which is based on the BIS and then this data, locational data, and this is a chart that we, together with IMF colleagues, we regularly publish quarterly in a publication under the Vienna initiative. I will mention it a little bit later. In this chart, we show the reversal of debt flows to the transition region prior to the crisis and since the crisis. I ask you to focus on the red light. The green light includes Turkey and Russia, which is a slightly different story. But if we exclude them, the red light shows that there was indeed a huge increase in cross-border exposure by the parent banks to emerging Europe, just a story I've been just describing. And then a gradual, first a little reduction and then much deeper reduction later on. The first decline was really the response to the global financial crisis, and the second is the response to the Eurozone crisis. So one thing to note is that actually the decline was more substantive than during the Eurozone crisis, when the parent bank were directly hit, than in the first part of the crisis, the global financial crisis, when more the emerging European region got affected. Overall, since 2008, until the first quarter of second quarter actually, 2014, we have new data. The region has lost 190 billion or so US dollar worth, or 11% of GDP, 1 year GDP funding. That's not little.
This is despite the Vienna initiative.
That the first one was a temporary impact for in 2009 and beginning in 2009 to end 2009, the Vienna. So there was a decline, but then a little leveling off. Then that was relaxed. So I am gonna talk about it. The second one, we didn't have these exposure commitments at all. That was a crisis related of the parent banks. So that would not have been sensible to ask. But what is interesting to see, perhaps, that there was a decline in both periods. But the first period was about 60 billion, and the second period, sort of Eurozone, post-Eurozone crisis, it was 130 billion. So the two-thirds was really as a result of the Eurozone crisis. So talking about the Vienna initiative, Max specifically asked me to discuss this, and Adam already alluded to this. Let me step back a moment and take you back to the end of 2008, when emerging Europe, which again was so closely integrated with advanced Europe, got hit on its vulnerabilities. There were very high external account deficits, of course. There was some of this was misdirected, as we know now, into unproductive outlets as well, including construction, real estate in several countries. There a lot of consumption-related lending also, although investment as well. There was funded growth as well. And there was a moment at the end of 2008 when there was a possibility that with all these vulnerabilities and global liquidity drying up for everyone, you might recall that was a real big shock, the end of 2008, early 2009, there was a prospect that the few banks, parent banks, which owned practically all of emerging Europe's banking sectors, would actually run to the exit. If not with equity, that would have been more difficult, but definitely with liquidity in massive forms. Even though they would have liked with certain assurances to stay in, they believed in emerging Europe's convergence down the road, but of course the hit was tremendous, and the vulnerabilities were significant, high current account deficit, etc. So in this context, and given that there was really no discussion between the home supervisors, Austria or the Hungarians, of how to handle this huge systemic risk of a regional scale, of parent banks, Raiffeisen, Erste, Unicredit, Intesa, the Greek banks, the four Greek banks, running to the exit in terms of at least liquidity, and no discussion whatsoever. Together with the IMF and the Ministry of Finance, we sat down and said, well, we have to do something about this. There is no regulatory coordination. At that time, the Commission, sorry, this is public, but fact remains, thought that the crisis should be solved at the national level. There was no EU-level crisis response, 2008 and 2008. And therefore, we had to find some kind of an innovative solution. So we sat down with the Ministry of Finance of Austria, the IMF, and ourselves, EBRD, and we thought that we really have to find a framework in which we can ask these parent banks to take a longer-term view and not withdraw liquidity immediately, if, in turn, the host countries, Hungary and the alike, would commit to good policies and to certain responsibilities under IMF and EU-led programs. So it was a quid pro quo. The host countries promised certain things, good behavior, so in broad terms, good policies, and assurances under IMF and EU-supported programs that they remain on track with the macro programs that were put in place in 7-8 countries at the time. And in turn, parent banks would accept the responsibility of not withdraw liquidity from their banks, region-wide. And that's exactly, I mean, it was slightly unbelievable that this could be pulled together, but actually it was pulled together, because in the end, parent banks were interested to stay in. They, again, believed in sort of longer-term potential of the region. They had invested also, frankly, a lot in terms of equity. And they got assurances that the countries remain on good behavior, good policies under the IMF and EU programs. In turn, investing IFIs such as EBRD ourselves, the EIB, and the IFC, we also made a pact with parent banks that we support them with big mega packages. So we, on our side, EBRD, we gave a big mega package to SocGen, to Erste, to UniCredit, and later also to the Greek banks as a group, to be used to support the subsidiaries in their region, so that they can really commit to keep the liquidity in their subsidiaries. So it was a little bit of a public-private sector coordination platform. Sitting around this was the home country authorities, the Austrian, Italian, French, and the like, both the central bank, the regulator, and the Ministry of Finance. Very important. In the end, it was about public money. The host country authorities, the Hungarians, the Romanians, the Serbians, and the like, 7-8 countries, also Latvia, of course, was under an IMF EU program. These parent banks and the IFIs, which provided the investing IFIs, of course, an IMF and the Commission. And the parent banks, under these conditions, signed public commitment letters that they would keep in liquidity, and the IMF monitored this commitment. So the bottom line was that there was a burden sharing both by the regulatory authorities, the Austrians. They agreed that the Austrian packages they were put together for their parent banks as part of the crisis response in Austria or in Italy or in Sweden could be also used to support equity in subsidiaries. That was a big victory, because first they didn't want to do that. Obviously, there was national interest, national taxpayers' money not to be spent, in other countries. But this was overcome, so they agreed that these packages can be used in the subsidiaries. But at the same time, also the host countries committed to take care of deposit insurance claims if the case arises, and of local currency liquidity through the central bank. So it was a very nice quid pro quo, playing on the interest of all the stakeholders. And under the IMF EU programs, we monitored it very carefully and quarterly, and liquidity was kept in these countries. This lasted for about 3 quarters, because obviously this was de facto an early bail-in, going a little bit against the market forces of deleveraging, which was, of course, and macro adjustment, which was necessary. There were excesses in the previous model, even though on the whole that worked, but the external account deficit, the use of foreign savings, was excessive in the end. But altogether, this allowed to keep for a limited period the liquidity that was really needed to avoid a systemic meltdown in the region's banks. Now, how it worked in the end, I think partly it worked because there were very few players, only a few parent banks. Here we were discussing with basically 10. So accordingly, very few home country coordinators. And the packages that both the IMF and the Commission and we as investing IFIs put down on the table were also very significant. From us, we provided 33 billion in 2 years for these parent banks. That was not a small amount of money. What was avoided, again, for 3-4 quarters, for a year or so, is a massive run to the exit in a coordinated manner. And what was important, as we learned later on when we were drawing the lessons from this, from the participants, it was quite important that banks themselves knew what the others were doing. So KBC from Belgium, say, knew what Erste was doing in the same country, say Hungary, because they are both in there. So there was no uncoordinated run to the exit. They had these assurances in the context of this coordination platform. It didn't have to last very long because in the end adjustment and deleveraging had to take place. But it was very important and at a time of a major systemic shock phase to have this type of coordination arrangement. But in the end it was just a stopgap measure. And this is really what is relevant for the banking union subject. There was just no coordination. So the IFIs had to pull together, the Austrians and the Italians and the Hungarians and the Romanians, the Serbians around the same table to say that we have to coordinate. Because at the EU level, there was zero coordination. There were MOUs, which the brilliant Deputy Finance Minister of Austria at the time said, I had an MOU with 100 countries, and when the crisis hit, I had no clue in which drawer in my armoire that MOU was. So it was completely useless. So overall, for a limited period of time, this public-private coordination platform worked. It was designed to be a time-wise limited, and by the end of 2009, so after a few quarters from the beginning of the crisis, the exposure commitments, 100% commitment by parent banks to keeping liquidity in their subsidiaries has been gradually relaxed under the IMF programs, and in the end was gone because there was no reason to maintain those. And there was no failure of foreign bank subsidiary. That is true even today. There were many locally owned bank failures. And in the end, although there was, of course, an overall capital outflow, but relative to the overall stock, that was the lowest in emerging Europe when we compared with Latin America or emerging Asia. So that was the first part of the crisis. Then, of course, we had the Eurozone crisis, and as I showed you in the previous chart, the loss of cross-border funding, that was the real hit. So 2/3 of the loss of cross-border funding came after the Eurozone crisis, when the parent banks themselves had become the source of vulnerability, and they had to deleverage and adjust. But I think that's enough for history, and maybe just remind us where we are today, because that brings us back to the subject of the banking union of today, and where we are. Where we are in emerging Europe, we do have some good news that indeed the model, the growth model, very heavily, possibly excessively relying on foreign capital financing, has been rebalancing. There has been some increase in domestic deposits and the use of domestic funding, much less foreign exchange lending. Overall, emerging European countries have behaved. They exited the IMF EU programs successfully, and Latvia, probably the most hit and most difficult case, Latvia has exited to the Eurozone. So very successful macro and over restructuring program there. And in the end, the banking union project is underway. We have the launch of the SSM, November 4th. So with the help of now the ECB being at the helm of and in charge of cross-border regulatory issues, hopefully this lack of regulatory coordination between home and host countries for emerging Europe will be, over time, will be taken care of. But I want to tell you that there are some worrying news in this region. In some countries, there has been a reversal of reforms. Unfortunately, my country is in the lead in that. But not only. In some other, this is quite appealing as a strategy elsewhere, as we are 6-7 years into first global and the Eurozone crisis then. There have been reversals in energy pricing, there have been reversals in pricing in utilities, and particularly in the financial sector, where the foreign ownership has been under attack in various forms. And in general, there has been an increasing anti-foreign sentiment in quite a few countries, which has manifested itself in the banking sector in calls for national targets for bank ownerships, i.e. Hungarization of the banking sector, at least 50% of bank assets to be held by Hungarians. And I was shocked to learn that at a recent conference in Poland that even there are very serious people calling for a certain target also in Poland, a country which has been spared and one of the best performers during the past 6-7 years in Europe as a whole. And I'm saying is that we can of course frown and say on the emerging European politicians, a bad bunch, etc. But the fact of the matter that politics does matter, and I think some rebalancing of this very, very dominant foreign ownership, unfortunately, may be necessary also for political economy reasons. But then getting closer to the subject matter, the direct subject matter, against this background that I described, in a sense the banking union, which aims to provide an independent and informed regulation of cross-border banking. For emerging Europe, this is a brilliant news. The problem has been that there had been so much market integration and so little regulatory coordination that had become a problem. So for the banking union concept, actually, this is great. When we heard first about it mid-2012, we were just, of course, just as surprised as most of the world about, the enlightenment of the European leaders when crisis hit, sometimes they can pull their act together. So we were stunned in a positive way because we said, well, that's exactly what the Vienna initiative was substituting for. So it's great. We're going to have a matching cross-border regulatory system matching that of the very extensive, maybe overly extensive for political economy reasons, financial market regulation. And again, maybe just a reminder that the emerging Europe actually is coming from a very heavy cross-border equity ownership, which is like a capital market concept, a very strong cross-border equity relationship already when you compare it with Western Europe. So on this chart, I depict for you the share of foreign-owned banks in Western Europe first, that's the darker blue, and then Eastern Europe with lighter blue bars. As I was saying, Estonia and others, 100% foreign ownership, no local banks. Whereas in Western Europe, except for Belgium, there is really very little cross-border equity ownership. There is a lot of debt ownership. Well, the Eurozone crisis, of course, led to fragmentation and bank nationalism, we know. But overall, equity, very little cross-border equity. Huge in emerging Europe. So for emerging Europe, this is a brilliant concept. This is what has been missing. Now, so we are at the banking union, the three pillars, single regulatory, single supervisory mechanism, ECB in charge of any systemic cross-border banks over 30 billion asset size. And here is emerging Europe, which finds itself in three categories vis-à-vis the new banking union. The banking union, of course, is for the Eurozone only, as you know, because of the British opposition. Primarily, the banking union concept is constrained to the Eurozone. And to the extent that emerging European countries are Eurozone members, naturally they are subjected to that. There's an automatic membership. So these are Slovenians of the world and all the 3 Baltic countries and Slovakia. They are members. So for them, the issue for the banking union is the same as for the others, and that we know that there are big issues. There is incompleteness of the system. The resolution system is not there, deposit insurance later, but they are in, so they can fight for the interest from within. But there are 2 important groups of countries which are not Eurozone members. One is the EU members outside the Eurozone. In our region, Poland, the Czech Republic, Hungary, Bulgaria, Romania, Croatia. They are in the same category as the UK, of course, Denmark and Sweden, EU members but non-Eurozone members. And for these countries, there is a possibility of opting in, having a very close collaboration with the banking union. That's the rules of the game. So these countries can say that they would like to submit and actually hand over the supervision of their banks to the ECB in every single respect. So it's the same rules of the game as in for the Eurozone countries, as if they were a Eurozone country. But of course they are not Eurozone countries. So they are only observers in the governance structure of the SSM. And of course they are not, they don't have automatic access to the backstops, ESM, European Financial Supporting Mechanisms, ESM and others, or the swap facilities of ECB or ECB monetary support in the end. So this is one group of countries. The most systemic one, of course, is Poland in our region. And they can, ponder over the pros and cons of opting in or not. But there is this other important group of countries. These are the non-EU countries, typically Southern Europe, whose banking sectors are absolutely dominated by Eurozone-based banks, and they can't at the same time opt in to this enhanced regulatory cross-border regulatory system, the single supervisory mechanism. This is Southern Eastern Europe. And there is a huge regulatory gap in prospect for those group of countries. They don't have a choice. They are outside, and that's it. So let's look first at the opt-in countries. So the Polands of the world, in addition to the UK, Denmark, and Sweden, who has the same interest. So these countries have considered and are considering very actively Poland, Hungary, and the others, whether they should opt in or not. And the fact is that only 2 have signaled interest, and these are the 2 which are considered the latecomers to the EU, those who entered in 2007, and who, on the estimation of markets in general, are considered the weaker ones. So there is interest, but these are Bulgaria and Romania who actually have signaled interest, and not the stronger ones, the Poles in particular. So that's an interesting, curious thing. Now, why that is the case? When, as I was trying to describe and explain, actually, this is, the banking union is a very brilliant solution for the regulatory problem that these closely integrated financial markets have posed for policymakers. So why the hesitance? Number one is, of course, the problem with the Eurozone. I mean, fact is that the crisis, maybe the existential crisis is over. I think not maybe, it is over. But there are serious questions about some of the experts of aspects of the Eurozone and the sustainability in the eyes of some politicians, and therefore an understandable reluctance to jump into the project perhaps very early on. We've seen this wait-and-see attitude voiced by a number of countries. Hungary, there is a working paper by the central bank which takes this attitude. So let's see what happens and see whether the SSM, the single supervisory mechanism, the ECB-led new cross-border supervisory system, really works, and then we decide. So that is Hungary. Poland has voiced similar views very eloquently, the governor, on a number of public occasions in the past few months. They also have highlighted that they have certain fears of giving up their macroprudential powers, which are quite significant. Poland is one country where the regulators relatively early on reined into FX foreign exchange lending because of the systemic risks, and there is a fear that they don't see quite whether the SSM and the ECB would fully internalize systemic risks in their country, in Poland, at this stage. So there is a reluctance for that reason. But I think my sense from the very close discussions that we have with these countries, Poland and the others, is that the two real reasons are perhaps the last 2 points that you see on the slide. And that is the lack of access, a public commitment to access to FX, foreign exchange liquidity, in the case of external shocks, even for good behaving, good policy track record countries such as Poland. What exactly do I mean? I said just back in 2008, when global liquidity really dried up, the ECB provided swap facilities to the UK, to Denmark and Sweden, of course had a long-standing arrangement with the US, to mitigate shocks in FX markets and liquidity. And they did this against local currency collateral. So there was no question that the ECB accepted collateral, say, from Sweden. Actually, Sweden used it for the Baltic countries in part, but that's because of the very close collaboration in the Baltic region between Sweden and the local authorities. When the Hungarians and the Poles asked for a similar facility, not similar, exactly the same, and they were turned down, and they were given a facility only against foreign exchange dominated collateral, which honestly, I mean, was not a big deal. If you have foreign exchange liquid collateral, then you can borrow in foreign exchange, so you don't need the ECB for that. I'm a little bit too harsh, because actually in the height of the crisis, markets took the deals that the Poles and the Hungarians received, i.e. FX swaps with the ECB against FX collateral, as a good news. So there was a market enhancing element, benign neglect really by market participants in the chaos that reigned at the time. But it was really not the same deal as given to the other non-Eurozone countries. To two countries, or three, I can include Romania here, which had one form or another a strong IMF program. Poland is a precautionary; they didn't need the liquidity. They were, a country of very strong track record, but they had a precautionary agreement with the IMF. Or Romania and Hungary, which had a very strong program with the IMF and the Commission, and stick to that program. So Poland and Hungary felt offended, if I may say, that they were refused to have the same FX lines as good performer countries as others, and they have asked, therefore, the ECB publicly whether, if they join the SSM, the ECB-led the supervisor mechanism, whether they could have a promise of having an access to FX swap lines if their track record is impeccable, policy track record, at a time of a big shock, currency shock or external shock. And just have the same as what the Swedes, the Danish or the UK would be automatically almost eligible for. And this has been a very strong point for these countries, for Romania, Poland, I believe also for Hungary, but it has not been granted. And that's a sour point. I think this is a mistake. This is a mistake because it would give a huge incentive for countries to opt in early if you really want to have a fully inclusive banking union. And I think the ECB and the Eurozone in general would like to have important countries such as Poland under the tent as soon as possible. And the second point is access to fiscal backstop under the single resolution mechanism. That's a little bit more difficult because these are capped, of course, for Eurozone countries. But actually, this is something that is being negotiated. Poland, Hungary, Romania feel quite strongly about this. And it could be important, even though, of course, under the EBRD, the Europe-wide new bank resolution mechanism, use of public resources, particularly at the Eurozone level, supranational level, is really just the last resort. There is a very strong system, at least in theory, of bailing in first the equity investors, then junior debt, and then going down the waterfall, before any public money is committed, and before any euro or supranational level public funds, taxpayers' money is committed, there is national taxpayer money use as well. So how important the last one, access to supranational mechanisms for potential opting in countries, Brussels argues this is not that important, these countries argue that it's important, but it's negotiable, hopefully. The third one, the ECB's swap line, honestly, this should be a no-brainer. This should really happen. Sweden has it, UK has it. If these countries have the same good policies, they commit to good policies, good policy track record, there is really no reason not to have this, and it would give the right incentive. But then we have the third group of countries. These are the Serbians, the Albanians, Bosnia-Herzegovina, tiny little countries, of course, Macedonias of the world, where banking sectors are fully dominated by Eurozone-based banks, but they are outside of the EU and they cannot opt in. So, if there is no framework for regulatory coordination between the new super regulator, the ECB, and these countries, there is a tremendous regulatory gap. The Serbian regulator is sitting, theoretically supervising subsidiaries which are actually supervised by the ECB. However, if the Serbian regulator is not talking to the ECB on a regular basis, they don't exchange information, don't share information, don't sit around the table if there is a stress situation, there is a huge regulatory risk. Now, this is recognized, of course, by the ECB. And what they have envisaged under the SSM, with the help, of course, EBA. EBA is the EU-level coordinator for all the 28 countries, is what they call a third country discussion, third-party discussion with these countries. It would be the same as what they have for any supervisor which has either a subsidiary or a branch in the EU or which hosts Eurozone-based parent banks. So it could be Singapore, of course the US, it could be Brazil, it could be Australia. No matter how little the exposure, this is the same blanket third country coordination agreement. And we really think that this is a problem. It's a problem because these countries, again, I mean, they are not simply, have a little branch here or a subsidiary there from the Eurozone. They are dominated 90%, 100% by Eurozone banks. On top of it, they will be becoming an EU member and perhaps down the road even a Eurozone member, and they are in the neighborhood. So there is a reason to argue, I think, strongly for a special regulatory coordination between these countries in Southern Eastern Europe, would be EU members down the road, and the ECB. And that's what under the Vienna initiative now we call it Vienna 2 because it's not about exposure commitment really, it's about looking at systemic risks in other areas. We have been working on with the ECB and the EBA. There are two issues, very briefly. Of course, there has to be, the ECB has to be assured, and the EBA, that these countries can be trusted, their supervisors can be trusted to handle confidential data. And therefore, there is a precondition of a confidentiality assessment by EBA that needs to be performed on supervisors such as Serbia and alike. And this is what I'm happy to say. I think with a collective effort, we have managed to get. So these confidentiality assessments are now underway for all Southern Eastern European countries, except Kosovo. That will be a year later. And we even have an understanding that this will be also done for Ukraine, which is of course a very different subject matter, but they are also foreign Eurozone-based bank, basically captive in that country. So these confidentiality assessments are underway. There's a good movement, and we also now take part in a special working group of EBA that negotiates this third-party agreement between third countries, host countries, and ECB, EBA. I think the important thing is that under the Vienna platform, actually we pull these countries together, the Serbians, the Bosnians, the Montenegrins, the Macedonians, tiny little, but they add up, pull them together, and they negotiate now with the ECB as a bloc, not country by country. Because otherwise, honestly, I mean, they are very small. And why the ECB is, of course, very enlightened and sensitive to systemic risks, but there is so much care and focus they can give to a subsidiary which is 0.01% of a parent bank balance sheet, but which has 30% of, say, Montenegro's banking system. But as a bloc, they have a chance to negotiate good agreements, hopefully. So this is where we are in terms of the banking union. So again, given the history, emerging Europe should be well advised to join the banking union, but there are some concerns, legitimate concerns, and again, there could be incentives given for them to join, and for those outside the EU, special arrangements appropriate for the systemic risk, for banking systemic risk and regulatory gaps for their countries could be negotiated. But that's the banking union. Now the new thing is the capital markets union, right? So the new commission team has taken charge. We now have a commissioner which is in charge, among other things, of capital markets union, a Brit. Now what does it mean for emerging Europe? I thought I put up a slide for you on that. Of course, we don't really know what the capital market union as a concept is. We just had a very big meeting in Brussels 2 weeks ago, and the humble, very nice European Commission representative said, senior level, that we have the title, and now we are developing the concept for the capital markets union. So, what is the perceived objective? Very sensible. Is that the Eurozone and the EU should not only focus on fixing the banking sector cross-border regulatory problems, i.e. banking union, which is basically dealing with debt flows cross-border on an equal footing, providing an environment for that, but really should try to focus more and increase the weight of other non-bank type of institutions, such as pension funds, insurance funds, private equity, and all the shadow banking variants that exist, and some of it would survive even under a more close regulatory framework. Because Europe is overbanked. I don't know how many of you may have seen an ESRB working paper back in June. It's a brilliant short paper which just says it all, that Europe should have much less banking. So banking union is important, but should have much more non-banking sources of funding. Europe is too binance for banks and underestimates the importance of other sources of funding. And actually, of course, it is a problem for immediate financing for SMEs and the like, but there is an overall major structural issues in that respect in Europe's financial system as a whole. So the Capital Markets Union would look at not only cross-border banking linkages and particularly debt relationships, and ensure that there is equal treatment or no national capturing national interest in the Eurozone banking systems, but going beyond that and look at cross-border equity relationships where, as I have seen, the relationships are very weak. But I think there is also a secret objective is that you can actually incentivize the Brits to remain in the EU, and there's no wonder that there is a Brit gentleman who has this work theme in Brussels. Now, what does it mean for emerging Europe? It's good in many respects, but emerging Europe has a number of problems on its own. It's nothing to do with advanced Europe or the Eurozone as such. That the basic problem is that banks, of course, are very dominant in this region, and there is very little domestic savings and equity, and there is a need for a lot of some bank savings as such, but that's okay. The main problem is really self-inflicted at this point on capital market concepts in emerging Europe. And that is that quite a few countries recently have massively attacked private pension funds in their jurisdiction, and de facto nationalized or regulated in a way private pension funds that has extinguished them effectively as a major investor in their countries. The key leader, unfortunately, again, is my country, Hungary, where there has been a de facto nationalization of private pension funds. But unfortunately, Poland hasn't been lagging too much behind, and the role there of private pension funds has been also severely curtailed. And this idea, unfortunately, is quite appealing in some other countries as well. Why is it a problem? It's a problem because you eliminate a basic investor, a non-bank investor source from your financial system, and you continue to stress the importance by default of banks in your system. Why this is so, probably we don't have Adam time to go into. But I think beyond fiscal dominance reasons, like in Hungary, there are problems of incentives in the fiscal accounting as well at the European level, inasmuch as confiscating private insurance funds in the fiscal accounting theme of Brussels actually improves your fiscal account and definitely improves your debt to the extent that you take on the assets and reduce your public debt. So the incentives from the fiscal accounting side from Brussels have given a boost to nationalistic thinkers and to politicians who, for one reason or the other, didn't like private pension funds in their system. If the Capital Markets Union is a serious idea, then I think Brussels needs to revisit these incentives. So to recap this whole, I thought to show you something simple that you probably are very familiar with, is the financial, as a summing up, the financial trilemma of Europe. This comes from Dirk Shoemaker, so it's not my invention, but I think it's pretty good and very telling, which says that when you have three objectives, strong integration, financial stability, and sovereignty, you can satisfy any pair, but not all the three at the same time. Pre-crisis, the focus was on integration and keeping sovereignty, and not on financial stability. And the crisis very clearly showed that. Now, post-crisis, the La Rosière report and all that, we have a new structure. We've had a new structure, EBA, stress test, and the like, strengthening the core, the EU level discussions and thinking, but still having a very strong sovereignty and national interest. That was the solution, but it didn't really work, as we know. And we had the Eurozone crisis. And what we have now, to jump to today, is the following. That we have banking union, to some, which basically gives primacy to integration and financial stability. Good. But not national sovereignty. Whoop, this works. But that's the idea. But those who are outside, it's not a union, it's a fragmentation. They focus on stability, financial stability and sovereignty. These are the poles and all that. If they stay really for a long time outside, they have a strong incentive to maintain the ring fencing that we have seen in the context of the Eurozone, within the Eurozone as well, and nationalistic banking behavior. So we have a banking union satisfying financial stability, integration, for those who are in, and then a likely fragmentation for those who are out. So that's the last slide of mine, that I think this frozen situation that there are ins and outs, it is frozen. It would be a really big mistake and would probably undermine cross-border banking on the longer haul. To start with, of course, this is not by design. This is the UK's fault, as Brussels would point it out. The banking union was meant to be for the whole EU. But frankly, of course, this would be, even if it were for the EU, I would argue for you that those who are outside the EU but dominated by Eurozone banks, we would have the same problem. And if there are no incentives for opting in and no special, very strong coordination, regulatory coordination mechanism for non-EU members, one could see a future in which cross-border banks would operate in multi-regulatory jurisdictions, one for the Eurozone, and then, in strengthened nationalistic Poland, Hungary, Bulgaria, Romania, etc., 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 etc. So that, I think, is a major risk because in the end, Europe, financial markets are extremely integrated. This integration actually has been stronger outside the Eurozone and advanced EU in emerging Europe. So it would make sense to bring in those who are outside the Eurozone as soon as possible under the banking union or capital markets union project. What can be done about this is, and that's my number one message, they should be given incentives for opting in for those who can, EU members, Poland and the like. Primarily the FX swap mechanism. It exists for the UK, Denmark, Sweden. Why not for Poland? It doesn't really make sense. And it would be really important for the Poles to have that assurance. Good policy track record in crisis due to external shock, to have this currency swaps against local currency collateral. For those who not EU members, there should be a special regulatory coordination. These are the southern Eastern European countries. Ukraine, once it stabilizes and confirms its path to Europe. Of course, there is the general issue. We didn't discuss it today. That was not the focus. That, of course, the banking union is not a complete project, and it has to be completed. And European politicians and national politicians, more importantly, perhaps, should not wait for another existential crisis to complete the banking union project. This is very important. And of course, it's very good to focus on capital markets union, but from the emerging European perspective, it's very important to look at all the incentives, including the Stability Pact incentives in terms of fiscal consolidation that can have for the private pensions have a perverse effect on policymakers' incentives. It's very important to revise those rules, and so that emerging Europe also can embrace a full capital markets union. And I think that's it.